Good afternoon, everybody, and welcome to our webinar on planning your law firm's wealth management and retirement. Appreciate you joining us. I am Paul Myers. I am the CEO and Chairman of Advocate Capital, Inc. We are, as you may or may not know, a wholly owned subsidiary of Pinnacle Bank, which is a bank headquartered here in Nashville. It's about a $45 billion in asset organization. We're proud to be a part of that organization. And joining me today is Jeff East, who is with Pinnacle Wealth Management. Jeff is a Senior Vice President with Pinnacle Asset Management and offers securities as a financial advisor through Raymond James Financial Services, Inc. Jeff has worked in the investment services industry since 2007 and provides discretionary investment management tailored to the individual needs of his clients. He considers tax advantages in his work in both individuals and businesses. Jeff came to Pinnacle from Regions Investment Solutions, a division of Regions Bank, where he was a financial consultant. Previously, he was an investment management consultant with Keegan Company, which is now, oddly enough, part of Raymond James Associates. So I'm really pleased to have Jeff here with us. A few housekeeping notes before we really get going. If you have any questions as we go through this, please use either the question box or the chat box on your webinar app, and our production assistants will make sure that gets over to me so I can ask Jeff those questions as we go along. There will also be a more open Q&A session at the end if you want to wait till then, but questions during the presentation are very much welcomed and encouraged. So be thinking about those and ask where you need to. One more housekeeping item. As we go through this, we will be sending, remember, you don't have to remember everything that's said. We'll send you, all the registrants, a videotape of this webinar, so you'll have that to refer to, and we'll also give you both Jeff's and my contact information so that you can reach out with any questions after the fact. So with that said, we will move forward to the disclaimer. This webinar has been prepared for informational purposes only. Please don't take it for any accounting, tax, or legal advice. If you have questions about that, please consult your professionals. Again, it's for information only. And with that, we will turn it over to Jeff East. Jeff, thank you for joining us.
Thank you very much for having me. Very happy to be here again, and it's a short drive from downtown to get over here, so glad to be here. Today we're going to talk a little bit about financial planning, investment management, planning for retirement, what that looks like. Taking a step back, just talking about my team at Pinnacle Asset Management. We're a team of 5. My job is to run the day-to-day operations for the team and work with clients. We work with clients, families, endowments, foundations, and then do a good bit on corporate retirement planning. So today is going to be a little more geared towards the individual and family. And so we'll kind of go through how we work with those type of clients.
Sounds great. Let's get going.
So planning for your financial future is a big deal, and it does take some time to really get what we're trying to accomplish done. It's like I tell clients all the time, it's like we're building a house and you're working with that architect or house plan. Put every bell and whistle you could ever want in that financial plan. And then as we get into it, if the budget doesn't allow, we'll have to take things out. But it's a lot easier to take things out on the front end than have to put them in down the road. So let's get everything on paper. We'll stress test the financial plan, see how we're doing. And then if we need to take things out, we can.
Great.
When we're working together, what to expect, it really is a 4-pronged approach. It's I need to understand what you want to do.
Right.
What is your why? What are we trying to accomplish now and down the road? Design, how are we going to design your financial plan, your portfolio, different type of accounts? How are we going to structure all that? Then we need to take that design and make sure we implement it in the proper way. Make sure the accounts are titled correctly, make sure if there's trust that they're flowing to the trust if something were to happen, and just making sure that implementation phase goes as smoothly as possible. Then we're working together, then we're constantly managing the portfolio, managing the financial plan, making sure everything stays how we design it to be. And those are quarterly and semi-annual meetings to make sure that takes place.
Excellent.
Just wanted to talk through key terms that are in the industry, and so if I'm preaching to the choir, I apologize, but just wanted to kind of get it out there because these are things we use every day. Asset allocation, that's just your investment mix. I mean, how much stocks do you own? How much bonds, cash, alternative investments? All that together is your asset allocation. Asset class is stocks, bonds. Are we large cap? Are we small cap? Things of that nature. The rebalancing piece is a big piece because, again, we've designed this plan and we want to make sure the plan stays the way we designed it. And so every 6 months, every year, we do need to rebalance your portfolio to make sure we're still in that proper asset allocation mix. A security is just an overall categorized two different stocks and bonds, and it's just what we own in portfolios are going to be the main bread and butter that we own in the portfolios.
Okay.
Mutual fund is probably pretty common, especially in retirement plan business, in your 401ks or 403bs, and that's just a basket of stocks or bonds that a client owns. It gives them diversification and it gives them a good entry point into the investment world. So it's a little different than a stock because with the stock, you own that company. With the mutual fund, and the next one, the exchange traded fund, you're going to own a lot of different companies, where with one stock, you own one company, and we kind of build out your portfolio depending on your risk tolerance and asset size. We'll really go into if it's a mutual fund, we're going to own stocks, or we're going to own what's called ETFs, exchange traded funds.
Okay.
Options, it's a kind of a higher level type investment. It's just a contract to maybe buy the stock down the road at a certain price. We can get into that if people have questions of that offline. Bonds is owning the debt of a company, and so those fluctuate a lot with interest rates. And being a very unique interest rate environment we've been in for the last 18 months and probably going forward, those have gotten a lot of chatter from my clients. And then annuities are a conservative avenue to go down, whether you were looking for a stated rate of return or we're needing to fill an income need down the road. That's where annuity could come into play.
Right. Okay. A lot of our clients, prospective clients, use annuities. They'll basically what they do called structured settlements.
Sure.
Where they'll
exactly
instead of taking a large fee, they'll use the fee to buy a longer term annuity. Basically stretches out the income stream and provides tax benefits.
Absolutely. So, when we're working with clients, whether they're mid 20s to mid 70s or even older, we've got to lay the foundation. So that's a budget. It's how much are we saving? How much do we need to keep in cash or emergency funds? Once we go from that, it's okay, we've got the foundation. Now we need to see how we're going to accumulate assets, how we're going to build our wealth. Got to invest early and really make sure that we're mitigating risk. Okay. And then as we get farther down the road with your financial plan, are we spending the money and the assets wisely? What's a need versus what is a want or wish?
Right.
They're different things.
Oh, yeah.
And the spouses can disagree on what's a need and what's a want and all the fun things. So, it's an ongoing conversation. And I tell clients all the time that a financial plan isn't done when we finish it day one. It's an ongoing document because your life changes, the market changes, your portfolio value changes. So the plan is an ever evolving document that we'll review on a quarterly basis.
Okay. A couple of things you said beg a question.
Sure.
One is how much, I guess, starting with the real basic stuff, is how much of a cash cushion or an emergency fund should I have or anybody have?
So there are two answers to that. Okay. You can go with the financial planning definition, and that's going to be 3 to 6 months of living expenses in cash.
Got it.
So let's use round numbers. It takes you $10,000 to run your household a month.
Right.
6 months of that would be $60,000 you need in cash at any one time.
Right.
Okay. Whether that's checking, savings, money market, cash equivalents, that's what you need. That's your emergency fund. Any dollar amount over that is termed investable assets.
Okay.
And we need to have that money growing at a higher rate of return than cash. Okay. That's the by the book definition. But there's a behavioral finance aspect to it, that there's people that they need to see a certain dollar amount in their checking, savings, money market for them to feel comfortable.
Right.
And that might be a lot more than 6 months of living expenses. It can be less than 6 months living expenses, but you've got to marry the definition and the behavioral finance aspect of it together to find that common ground for the client.
Right. And I found, just personally, as we look at personal financial statements for some of our clients, and you recall that all of our clients are plaintiff attorneys, so the cash flow is not real nice and smooth. It's real choppy, and a lot of times, so a lot of our clients choose, from a behavioral standpoint, to say, you know what, I want a bigger chunk of money sitting in cash, because it could be 3 or 4 months before I see another verdict or settlement and get some income.
Sure. I mean, it's all client driven, and there is behavioral aspect to it. So we just have to be cognizant of that and talk through those aspects of the foundation of the financial plan.
Okay. We got another question for you, and I think the answer may also be in the traditional corporate finance answer is it depends. But how much should I be, or anybody be, saving on an annual basis?
Great question, and I get those a lot. Just kind of blanket statement would be, if I can get clients to save in the double digits, so north of 10%,
got it,
we're on the way.
Okay.
If I can get them to save 20%, then the financial plan will look a lot stronger down the road by being able to put money away at that type of rate. So
when you say 10 and 20%, is that 10% of total income before tax, total income after tax? Before tax. Okay.
Yeah. So pre-tax money, if we can get you in the double digits, we're in the ball game.
Got it.
If we can get you to 20, the financial plan will look very strong.
Correct.
Yeah.
Okay.
Good question.
All right. Thank you. All right.
So this comes back to that savings rate. If you are younger and you can't get to the 20% savings rate or 25% savings rate, that's fine, because you have time on your side. So this is a matter of making sure that we're putting money away. And as we get closer to retirement, those portfolio and the asset allocation is going to get a little bit more conservative, because we're getting closer to retirement and we don't have time on our side if we get closer to retirement for a market downturn or something that happens. So there's a little bit of defense being played in portfolios as clients get closer to retirement. So the younger you are, obviously you can take a little bit more risk. You have time to recover. As we get closer to retirement, you need to play a little defense in the portfolio. I will say, and I get this question from clients a lot, that they want to go to cash or be super conservative when they retire. Okay. Let's say client retires at 65. Well, life expectancy is mid 80s, modern medicine, maybe get to 90
more years,
So we need those assets to continue to work for you long into retirement. So it can't just go put it on the mattress when you retire. We need to really have a well-balanced portfolio that's doing everything we need to do for the next 20, 25, 30 years of your retirement years.
Got it. Okay, great.
This would be, next would be the spectrum of investment risk. So we talked about the foundation and making sure we have cash and cash equivalents on hand. The next one would be bonds and fixed income. So they're a step up from cash, not going to give us the type of return that stocks would, but gives us historically better returns than cash. So we go cash, fixed income, bonds. Then we're going to go into your blue chip stocks, blue chip growth, blue chip dividend payers. You're going to have your real estate, mutual funds, ETFs come into that world. Then the top of the pyramid, which is our most risky assets, will be your speculative stock, your smaller cap companies. Think of those startup companies in California, biotech, technology, things of that nature. And then you're going to do junk bonds, which is a way of saying non-investment grade bonds. So that top piece of the pyramid right there may or may not even make it into a client's portfolio, but that's the investment risk spectrum.
Yeah, and I would think, kind of tying back to what you said previously, I would think that as you get to the 65, 70 retirement age, where you really don't want to take the risk of a huge market downturn, perhaps you may be sliding down that triangle a little bit more than maybe you were when you're 40.
You absolutely would be. And the stock equity allocation, maybe you don't own all the growth companies. Maybe you own the value companies that have really good balance sheets, that pay good dividends, that we're going to be steady as you go type companies versus, the more growth oriented companies.
Got it. Okay.
So the next piece is, I always talk with clients, we have 3 buckets of money. First bucket is the bottom of the foundation, again, is cash equivalents. That's bucket number 1. Bucket number 3 is our longer term money, which would be IRAs, 401ks, 403bs, the money that you can't touch until you're 59 and a half at the earliest.
Right.
Okay. Clients do a really good job of having cash and putting money away in their 401ks, retirement accounts. Okay. They do a really bad job of bucket number 2, which is that 5 to 20, 25, 30-year money that it's not earmarked for retirement, but it doesn't need to sit in cash either.
Right.
That's the bucket that I try to get all clients to put money into, because there's no maximums that we have to adhere to. There's no limits.
Right.
You can put in as much as you want into those taxable investment accounts. So think about it. You win a big case or you sell a piece of real estate. Well, that money can't go into your IRA.
Right.
And we don't want it to sit in cash. That second middle bucket is where we see a lot of assets for our higher net worth clients. And, this chart depicts why we have to do both. We need the tax deferral in our 401k, but we also need to make sure we have that middle bucket taken care of. And yes, it is taxable on growth and gains and things like that. But, that's going to help allow us to hit our goals in that intermediate range for our financial planning.
Okay, great. All right.
So this is, we touched on it earlier. It was, what's a need, what is a want, and what is a wish. The needs need to be taken care of by that reliable income. So maybe it's a pension. We don't see as many as we used to of those. It's Social Security, royalty, maybe rental income, something of that nature where, that's a reliable income stream that I can count on to be my mailbox money every month. That's going to take care of my needs. The other wants and wishes is generated from portfolio returns, income off portfolios, dividends, appreciation, things of that nature. So as we work through financial planning, we got to make sure your cost of living and our necessities are taken care of by the reliable income, and then everything else we want to do is over here on the wants and wishes side.
Yeah, and as you said, I would think the wants and wishes and needs are going to be different client to client.
100%.
Yeah.
And it is, that maybe it's given to a church or a foundation.
Right.
Maybe it's buying a second home for the grandkids to come to at the lake or the beach. Maybe it's giving to university. Maybe it's renovation on a house. Maybe it's taking care of an elderly parent. I mean, it's across the board, and that is very much client driven.
Okay, great.
Yeah.
All right.
So now we're in retirement. There's 4 phases of retirement, and these are, earmarked different things. But you have the honeymoon phase, we have our big decision phase, we have our longevity, and how do we navigate that phase, and then we have, unfortunately, the solo journey. So with the honeymoon phase, it's what you would imagine. It's okay. We're retired. We're in good health. We have assets. We have, portfolio balances that are attractive to us. What are we going to do? So these are the clients that want to take a lot of trips, want to go see family, want to, maybe buy a second home or do some things. And, they're just enjoying not having to clock in and clock out of the job every day. So that's when we find clients are most active, but it's also when we find that clients spend the most money.
Right. Yeah.
And so, but it's a fun time, and we have to plan for that. After that, then it becomes kind of true life decisions on what we want to do. Do we want to get closer to kids and grandkids? Are we moving? Are we downsizing? Are we going to have to go, into a nursing home or have skilled nursing. It's some of these big decisions that, yeah, we've talked about, but we haven't really decided what we want to do. And so as that honeymoon phase winds down, then it's, okay, now what?
Right.
And then after that, it's navigating the longevity. When the quality of life is unfortunately going down, and we're not able to travel, and we're not able to do the things that we could do when we first retired, how are we going to manage that?
Right.
Is it, again, like I said, a skilled nursing coming into the house to help? Is it, moving into a long-term care facility? Is it moving in with a son or daughter or friend, things of that nature? So, that's a tough phase. And then it leads us to a very tough phase, which is, one of the spouses passes away. Now you're doing this solo.
Right.
You're by yourself, and maybe you're around kids, grandkids, but you're kind of living out your last chapter, solo.
Yep.
So it starts out really fun, the retirement piece, and then unfortunately, life does happen, and there's some big decisions that need to be made.
Yeah, and my wife and I are going through that a little bit with her mother and her stepfather, who just passed about 4 or 5 months ago, and watching her mother try to navigate. Fortunately, she was a teacher in Mississippi for 30, 40 years, so that's a tough job. But the good news about that job is it's got a fabulous pension.
That's right.
So she has full health care benefits, full pay for the rest of her life, plus Social Security, and she had done a good job saving money. So financially, she's in good shape. But now she's making those really tough decisions as to what do I do with all this stuff?
Yeah.
Do I sell our house in Mississippi, move up here to Nashville, where all her daughters live, and all that? And that's challenging. And I can only imagine how challenging it would be were she not financially stable.
Yes, and it's questions we get often.
Yeah.
And we just have to put them on paper and really talk through them.
Right.
But that's not a decision that the financial advisor can make. It's just we're a sounding board, and they have to do what's best for their own life.
Yeah. Thank you. Yeah.
So this is outside of financial planning, investment management. What else do we do for clients? We have to make sure you stay focused on what you're trying to do and your why. You get kind of caught up in the day-to-day of your job and family, and the market's up, the market's down, bad headlines, good headlines, and you see all this thing, and sometimes we have to just take a deep breath and let's talk about why we're doing this. Right. What is your long-term plan? And let's make sure we stay on that path. There's some times where we get in review meetings with clients. Yes, we talk about their portfolio and how it's doing, but we spend the most part of the meeting on, are you still on pace to retire and hit all your goals when you want to?
Right.
And if they are, then, the headline news is just noise. And we need to make sure that we're sticking to the plan and we're staying on pace. And so it brings them a little, calming to the meeting when they, maybe the market is down, but they're still on pace to do everything they want to do in 20 years from now. Then it kind of helps ease the mind a little bit.
Right.
So, and we also work closely with their CPAs and accountants on tax strategies, and are we going to do some tax loss harvesting? Are we going to make sure we can reduce tax burdens, things of this nature? But that's in partnership with their CPAs and estate attorneys, and making sure wills and trusts and everything like that are set up the way they want to, and then flow to how they want them to flow.
Right. Well, and one of the things that I've always valued in my advisor is communication. Because, for instance, I guess a couple of years ago, we were in the middle of renovating our house and had a lot of things going on, and it seemed to just be bleeding cash. And my wife, her famous line was, "Am I going to be a greeter at Walmart and when I'm 80 to be able to retire?"
Right, yes.
And I was like, "All right, we're going to go sit down with our advisor and let him explain everything we've got going on.
Right.
You don't need to hear it from me. You need to hear it from somebody who's professional." So that kind of communication, that personal service is huge.
Well, I'm an advisor.
Yeah.
And we just finished a renovation at our house. And there were days where I was like, are we still on pace? I had to be talked off the ledge.
Yeah.
And that's just part of life.
Right.
And whenever you take on a project, there are going to be some good days and bad days.
Yeah.
And, that's why we plan, and that's why we have, money in the 3 different buckets.
Right. Good. Great. Okay.
This is a overview, maybe it jogs somebody's mind for a question or two, but this is the entire financial planning services that we offer.
Mhm.
I mean, a lot of the big ones are retirement planning, asset allocation, but we also do a lot of corporate retirement planning. I mean, that corporate retirement plan business makes up roughly 20% of our team's revenue.
Right.
So it's a big piece of what we do for clients and business owners. And then obviously the investment management, but this is a very one slide that kind of checks all the boxes on what all roles we play for our clients.
And what I found that is very interesting is, I guess when I was much younger, I thought, okay, 401k, little cash set aside, and if I got anything extra, I'll just start buying mutual funds. And that's all well and good. But as you get older, you really do have to start looking at, and this is where a professional advisor really can be helpful, is, all right, what does all this mean long term?
Right.
I don't want to be just throwing spaghetti at the wall hoping it sticks.
That's right.
Who can help me bring all this stuff together, look at the tax implications, not only now, but what the tax implications might be in 30 years when I retire. All of those things I had never thought about until I finally sat down with an actual financial advisor and went, okay, this is all making a lot more sense to me now.
Correct.
And I'm a relatively financially savvy individual, but I just kind of thought I was going to buy a bunch of mutual funds and individual stocks, and it was, probably wasn't it was not a well thought out strategy, to say the least. But sitting down with somebody who knew what the heck they were doing, it made it all kind of come together. Okay, this makes a lot more sense now. So anyway, I would encourage anybody, if you don't have an advisor, I would find one. Don't try to do it yourself. It's kind of like doing work around your house. My dad told me one time, son, sometimes the best tool in your toolbox is a checkbook.
Yeah, that's exactly right.
Find a professional.
Sure.
So
absolutely.
All right. So this is a lot of more disclaimer stuff from the Raymond James side of the house. You can read that at your leisure. Really, Jeff, I appreciate you coming today. If anybody has, I've got a couple of questions, but if anybody has any more, please jump in. One question that I had, Jeff, is what kind of clients do you typically work with?
Sure. They will be more professional, a lot of attorneys, obviously, doctors, business owners. You know, they have some complex issues, whether it's a tax ramifications or high tax brackets or things like this, or a liquidity event coming down the road. And then from a investment dollar amount, you know, it's usually, you know, minimums around $500,000 and, you know, on up past there. But if you looked at our clients, they're going to be between the $2 million to $10 million range.
Okay, and that's an investable asset?
Investable assets.
Got it.
And so it's not where we have to stop or where we can start. I mean, that's just if you looked at our client base today, how it shakes out. But you know, we'll be happy to answer any questions that clients may have that we can help answer.
Yeah, and I know that we've had a number of our clients already reach out to you to get advice. With that, Jeff, anything else to add before we wrap?
No, I think, you know, given the last 18 months in the market where market's done poorly, trying to bounce back, interest rates are going up at a historically fast rate, reach out. We can be a resource. There's a lot of things, a lot of questions clients have, prospective clients have. So use us as a resource. We're on the team, so we'd be happy to help. Yeah,
as Jeff mentioned, he's on our team. He is part of Advocate Capital. If you go to our website, advocatecapital.com, you can find him in his bio there. If you want to reach out directly to Jeff, his email address is jeff.east, as in the direction, at PNFP, that's as Pinnacle Financial Partners stock ticker, but PNFP.com. I'm Paul Myers, P. Myers, P-M-Y-E-R-S, at advocatecapital.com. You can feel free to visit our website to learn more about this. Also see other videos and webinars that we have done in the past at advocatecapital.com/videos. Sorry, but I thank you all for joining us. And again, if you have any questions, please feel free to reach out. We appreciate you joining, and we'll talk to you soon.